Good afternoon, everyone. Welcome back to the channel. We are once again joined by Howard Chan of Kurv Funds. Welcome back, Howard. So great to have you on.
Great to be back, Coach.
Yeah. So last time you were on, it's been a while, but last time you were on, we were talking about how some of your dividend funds, like your TSLP fund, was able to pay more dividends towards the end of 2024 because it was able to harvest like more of the upside, I guess. Could you explain if that's still happening and how that works?
Yeah. So the single name income ETFs. We did our website. If you look, we kind of put things in different categories. So the six single names, mostly Magnificent Seven. Those have been doing pretty well. We've been pretty even in terms of our distribution. We right now don't, well, I would just say this. This year, we were able to do a lot of stuff that, if you go to our website under the tax section, this year, our annual report ends in May. We were able to generate pretty high return of capital, and we'll continue doing. Hopefully, be able to continue doing that to the end of the year and then onto the next fiscal year. And our goal is to try to make the distribution as consistent as possible. But we do have 3 months left of the year. So if there's a huge run, that the reason why we had extra distribution towards the end of the year is so we had a huge bull run by the
Right.
end of at the end of the year. So it depends on the market environment. But if you want to go here, if you go down, scroll down, actually, it would be good to show where people that is. So if you go down to the middle column, last thing is a supplemental tax information form 8957. Just go to 2025. So this is actually a form we submit to the IRS to show. I think people can't see on your screen because it's popping up in another tab, maybe.
Right.
Yeah.
Switch over.
Yeah. So if you go to the end of that table, it will actually show you the characterization of the distribution for the distribution for, in this case, TSLP.
This one.
Correct. Yeah. So the reason why it's a little bit weird is it crosses over fiscal year. So, but
Okay.
everything in 2025 is almost 100% return on capital. So that we have one for every one of our funds. So you can go in there and look at the quality of the distribution.
Awesome. Can you explain though, like how's that possible that it's so much? It's like 99.37% return of capital.
Yeah. So it's a bit of a management, but it's also kind of the environment that we're in. So if you recall, during the end of last year to, I would say, April, May, there was kind of a fall in asset prices, right? Because of Liberation Day, DeepSeek news, and stuff like that. So we were able to actually harvest the losses that is in the fund, realize them. And so that offsets a lot of the gains. And then some of the gains we actually pushed out of the funds through in-kind transactions. So we were able to generate essentially that high of return of capital in the fund.
Awesome. Okay. Yeah. So it kind of worked. Those 2 months out of the year that we were down kind of worked in our favor.
Yeah.
Now, so next question. So Tesla's had a similar run up over the past month or so. So would we possibly expect the dividend to be kind of closer to what they were the last time that happened?
I can't predict dividend, but if it continues to go up, just like last year, we will have more gains in the fund. So that's, but I don't, I can't commit to anything, obviously, because the market condition can change drastically in the last 3 months. So that's just the caveat. Yeah.
Yeah, we're almost back to all-time highs again.
Yeah.
Well, and as you know, we have a lot of investors that are in Tesla, the Yield Max fund, and they're seeing that it hasn't quite ever gotten back to where it was. So, there's a lot of capital looking for funds that can get back to where they were, when Tesla runs up.
Yeah, I mean, the one thing I would note is, all of our funds uh, were issued when we launched them at $25 per share, and
Right.
I think most of our funds, if not, are plus or minus a few bucks above or below that, and then some are significantly above that. So,
That is true. Yeah,
um,
it's over 25. You're right.
yeah, yeah.
And paying a decent dividend too.
So again, I think one of the key differentiators for us is we really look at guarding against NAV erosion
Yeah.
in our funds. Yeah.
I'm glad you bring up NAV erosion. So NAV erosion is something that I hear other fund managers saying either doesn't exist or it's not the proper term for it. Could you explain to the audience that may not understand, like just explain what they refer to NAV erosion, which may not be
Yeah.
entirely accurate? Yeah, go ahead.
Yeah. NAV erosion is an effect that happens when you over distribute from a fund.
Mm-hmm.
Right. So the easiest way I think about it, and this is sort of the smell test, right? If you have a fund that's following Tesla, it should move similarly to Tesla, right?
Exactly.
And if Tesla goes up, you should expect your fund to move up as well, right? But
Mm-hmm.
knowing that you have a covered call strategy, sometimes when things break out, you might not get as much of upside, but generally it should be going in the right direction. Now, the other side of it is if Tesla falls, you should expect your fund to fall as well, right?
Yeah,
What you
of course.
shouldn't expect is if Tesla goes up, your fund falls down in terms of NAV, right? And part of that is because if Tesla is going up and your NAV is going down and you have high distribution, you're essentially distributing part of your principal in your NAV to the underlying investor, right?
Mm-hmm.
What we want to do is distribute the gains that we generate from the option positions in the fund, not principal back to the investors. So that's the easiest way, I think, to think about it.
Mm-hmm.
Now, the I think it is very controversial in the community whether this exists or not. I would just say, if you're looking at a manager, the metric that most people look at is total return, right?
Exactly.
So if you look at total return, there's an assumption in total return that is baked in, is that you reinvest all of your dividends back into the fund. That's how total return is calculated, right?
Mm-hmm.
So that is an assumption that you have to make when you're comparing total return. It's probably the most apples to apples comparison. But we know that income investors are not 100% reinvesting the income back into the fund, right? A lot of people use some of the income either to live off of, or they even reinvest it in other funds, right? So when you calculate your return, your own return in your portfolio, if you don't assume 100% reinvestment, the returns actually look very, very different, whether you have NAV erosion or not.
Yeah.
Price return is essentially zero reinvestment back into the fund. So that's the two extreme. Total return is 100% reinvestment into the fund, and price return is 0% reinvestment into the fund.
Mm-hmm. Some characterize it as what this commenter said here, relative beta.
Yeah, your NAV should have a beta to what you're tracking, or else all of your why call it Tesla or Netflix or whatever, right? They have to have an exposure to the underlying, and if they don't behave like the underlying, there's something kind of funny there, right?
Right. Now, your funds actually, if I recall, do they invest in the actual underlying, or is it like the synthetic?
We have the capability of both. We
Yeah.
primarily do synthetics because we reduce some of the cash drag that you would have if you just held the stock outright.
Yeah. Now explain cash drag. That's like
Yeah. So even in your own portfolio, right? So if you have a basket of 10 stocks, right?
Mm-hmm.
As a portfolio manager who manages a fund, you have to keep actually a percentage, 2 or 3% in cash, because you just get cash from subscriptions, or if people leave redemptions, you don't want to be constantly buying and selling stocks because there's bid
Right.
ask and transaction costs, right? But that cash is not invested, so it's giving you 0% return. So that's what we call cash drag. But with options, you can get full exposure and still be very liquid. You see in our portfolios, we have money market funds and treasuries. Those are super liquid. So if there is any redemptions, we can actually take some of the money market funds to meet redemptions and then decrease the notional of the option. So there is no cash. There's not as much cash drag in the portfolio
Okay.
as if you just had a
Okay. Here's a good question. So about KQQQ, switching up a little bit. So
yeah.
based on how KQQQ is created, is there any specific percentage drip we need to do to keep no NAV erosion, as this may vary, but what could be the ballpark?
So if you take a look at the total return, if we use that, it's actually done quite well relative to Triple Q and actually other income generating ETFs that's tracking the QQQs. We have actually a lot of gains in the portfolio that you can see as the fund has gone up, the distribution has actually kind of gone up. So that, again, market dependent for the next 3 months, but we expect that the distributions to be pretty stable, if not increasing towards the end of the year. Yeah.
Mm-hmm. Oh, I like this chart here, how it's outpacing the NASDAQ 100.
Yeah, and that's end of September, correct. So here's another, we always get compared to a lot of other fund managers, and I would say one of the distinguishing features for a lot of our strategies is that we look to outperform the exposures that we are tracking. For most cover call ETFs, I think most income investors accept the fact that over a long periods of time, it's going to underperform the underlying because you're giving up some of the upside to get the income. And so we want to be a little bit different in that the way we manage our funds, we look to actually try to outperform the underlying. This is true with KQQQ versus the Qs, or our gold versus the gold product. And even the silver that we launch, that's our goal over time, is that we want to, you could get maybe best of both worlds. You have price appreciation, outperformance, as well as income. Yeah.
Mm-hmm. Yeah. So from a total return standpoint, you're outperforming the Qs.
Yeah, and Qs don't have. I mean, if you put in some of the, this is a whale in the industry, right? So I don't think if you put in JEPQ, for example, it's tracking the Qs as well. You'll see that like we've been able to outperform a lot of the traditional income generating ETFs on the Qs. Yeah.
Yeah, it looks like there was a real separation here as the market started running up. You guys were able to capture a lot more upside than JEPQ.
Yeah. So after Liberation Day, we do this thing called, and it's described on our website, it's like momentum weighting. So a lot of the stocks in the Qs are growth stocks, which have this behavior of momentum. So it's sort of like if a train is coming to you, don't stand in front of the train. Let it run, right? So we do a momentum weighting so that we benefit from the resurgence of risk when it comes back into the market.
Sure. Let's see. So now, so many other fund companies have leveraged ETFs. One even has yield boost now. Have you all thought of similar products out in the leveraged space and in doing a put and call strategy to boost yield?
Oh, we do that actually in the gold and silver strategy, and that's it's mostly because of the volatility in precious metals. In the equity space, typically implied vol is higher than realized vol, so you can write cover calls to get income. That's usually a positive premium. But in gold and silver, the risk implied vol sometimes is lower than realized vol. So what we actually do in the strategy is that we sell a straddle. So we write a call and we write a put, and we
Yep.
harvest the premium from both sides, actually. Yeah.
Oh, great. And this one's fairly new, the gold.
It's fairly new, but it's actually the fastest growing strategy we have. And it's part of it, of course, is the fact that, gold is, everybody's kind of concerned about the U.S. fiscal situation. Gold today just reached all-time high at $4,000 per ounce. So we've been a beneficiary of that, but we've also done actually quite well against GLD. And I mean, gold has returned, 15% since we launched that fund. Yeah.
Awesome. Now, what are your thoughts on, because some people say like gold as a metal or as a commodity versus the gold index, that there's a like disparity. I was wondering what your thoughts are on why that might be.
Yeah. So first of all, the gold ETF, if you look at the benchmark and the pricing, it's actually using London fix, meaning they take the price actually London. So sometimes there is a little bit of there's a little bit of a difference between pricing of gold. And one of the things that we launched in July 8th, and so we actually don't own gold at the commodity that you mentioned, because actually in US space, owning commodities generate what they call bad income, which is so we use options on GLD, which is in a security space, which generates good income. And so we kind of built that tax efficiency into the fund. And once it's a security, it generates good income. The income is treated like any of the other option incomes that's generated in our funds.
Okay.
Yeah.
Interesting. This person says they love the straddle strategy.
Yeah, it's been doing quite well actually for us in terms of catching the coupon, and then we are. We're generally Delta 1 in the strategy. So we will be a little bit, anyway, so basically we let even with the cover call, we're a bit of Delta 1 in the strategy. Yeah.
You have a fan here. He said he bought K silver and K gold. He says, thank you, team.
Appreciate it. I hope you did it early before the run. I think everybody who has been able to get into it in July have seen, or even before that, actually, before our strategy, seen a pretty good run in gold. Yeah.
So with these, with the precious metals and stuff, so we're just missing like a Bitcoin ETF or a crypto exposure.
Yeah, we are. We've been working on it. So that's something. Although, again, we two considerations, right? One is like, is this an asset class where we can outperform, right? We're very specific. We were in tech, we're precious metals, we kind of are reaching our goal. We are definitely looking at the crypto space to see what sort of outperformance that we can do historically. There's a lot of, to be honest, there's 13 Bitcoin ETFs out there, and there's a bunch of Bitcoin income ETFs. So we want to come out with something a bit different, but that's definitely on the docket, actually. Yeah.
Awesome. Now going back to the return of capital subject, this person was asking, so your fiscal year doesn't end December 31st? Is it like June or something?
Yeah, our fiscal year end is May 30th, May 31st. So if you look at all of the tax, it's up to May, but then we still provide the calendar year tax form for the funds. So we do it in fiscal year end. It's just everybody, like if you do it at close to the year end, it's kind of a cram in terms of the auditors and all that stuff. So we kind of put it in middle of the year. That's a little bit easier for everybody.
Oh, okay, makes sense. So as CEO of Kurv, what's your favorite ETF?
They're all my children. No,
Right.
I will agree that my favorite is AQQQ because it includes a lot of our outlooks about what is happening in tech, right? And where we're positioned. And just so for folks who are, want to know, there's two themes that we really like in the portfolio right now. We still are pretty positive on the AI infrastructure story. So not the software maker, but like the chip providers, the data centers, the cloud providers. Those we think still has a lot of demand and there's a lot of capital expenditure on it. We do think the economy is going to get softer going into the end of the year. So we're actually positioned in a barbell way into a more defensive tech. So those would be like Netflix, Spotify, Uber. Like these are the last things you're probably going to cut if you need to cut stuff, right? So a little bit more defensive. And then as we kind of seeing a little bit of the turn in the market, we put on more cover calls as well as some hedges in the portfolio. I would say they're all, for different reasons. KQQQ is a really good expression of risk on for us. K Gold is a good expression of risk off for us. So the two actually works really well as a pair.
Interesting. Now, so you think the economy is going to soften over the last 3 months of the year?
Yeah, I think you see labor market. Whether we go into recession is a different question. Okay, separate. You do see labor markets starting to slow down. Spending also, there's a bit of a question mark. And then just by the nature of we've been actually having a pretty fast growth for the last couple of years, this just naturally we're gonna have to slow down a little bit. And then of course, we think pockets of inflation is going to pop up, not all at once, but something that, will hinder growth a bit. So that's our
even more inflation. Oh no.
baseline. No, I think the
it's coming out
the way that we see inflation is that okay, can you hear me now?
Yeah, it's better.
Yeah, okay. The tariffs were originally being paid by the exporters. Then they were paid by the importers, and now a lot of the companies are saying they're going to shift it to the consumer. But it's not all going to come at once, right? So like, if you buy a new car, they're not going to raise prices like at this year's model, but they're probably going to raise prices on next year's model, right? So you'll see these like concentrated pops of them. Even if you look, the new iPhone, it was like at $999 for like 2 years, I think. And now this year they popped it, right? So people will start doing it when they have a model refresh. And that's what we mean by like pops of inflation is going to come in.
Okay, that actually happened. I bought a new car this year and it's a Honda Civic, and it said made in Indiana, which is in the United States, but they tried to put a destination charge on it. So,
yeah. So that's what we mean, right? Like it's not going to be like, all of a sudden everything pops 10%. It's going to be like, oh, the next time you remodel, okay, the prices are going to be higher than you expect.
Yeah, it's just crazy because we've had so much inflation already. Having more, it's like really
yeah.
Yeah,
but in some ways this one is a little bit of self-inflicted, right? Like we're putting tariffs on things that we're importing into the country. So
True. Yeah. Okay, so dividend on NFLP, 18%. So you still only have like 7 covered call ETFs or for individual stocks, right?
Six of them. Yeah.
Yeah. Any more coming? I'm surprised there's still only 6.
Yeah, I think we're probably, this is a good set for us. I think what we're really good at is having strategies that we run. So KQQQ for us have been doing extremely well. Gold and silver has been doing really well. So I think we're going to go in more of that direction where, the team has really deep expertise in managing around an asset class and various different names. The single names just a little bit more constrained, right? Because, we're just playing with volatility for that single name versus KQQQ. Our views change, market environment changes. We can adapt the portfolio in those particular environments.
Right. Well, actually, I will say no. It's a good thing compared to other companies. You're not churning out a new fund every month or two.
Yeah,
So
I don't. And they're, some of them are pretty successful. Others, I guess, less so. But um, I just don't think that, you know, there's 500 stocks in the S&P 500. Do we need all 500 of them having an ETF, income? Yeah. So
right, exactly. Only the big ones.
yeah,
So is the highest dividend probably still TSLP?
TSLP. I mean, people are surprised. KQQQ is actually pretty high too.
Yeah.
KQQQ is, I think, 18. Yeah,
Mhm.
18. So that's pretty competitive. Tech has had more vol, and then I would say gold is actually something that, for risk off asset and for gold who doesn't generate any income, 12% is pretty attractive. 12,
Mhm.
13, yeah.
No, I think it's great. That's exactly what people are looking for. Maybe a lower dividend, but more stable NAV and stable fund price. Yep. So this is a tough question probably, but how like any like status of it, like every company always has new funds in the works.
Yeah.
Um, but like how long? I know it's like 75 days or something.
Yeah.
Mhm.
We have one that will hopefully get approved, hopefully imminently, pretty
Yeah.
soon.
Okay.
I think the government shutdown hasn't slowed that one down, and so when that comes out, I'm happy to kind of come back and talk about it. But we have been asked. There's been request for us to do certain strategies, and we're hoping we can meet that demand. So
Yeah, for sure. Um, can you say at all, like, so the new possible fund, like what it might focus on or be, what it might like, any hints at all?
I we're in the blackout period for the SEC, so I'm kind of restricted from what I can say. But um, uh, I guess the thing I would say is just that, um, it's going to have the same quality of all of the other funds, in
Mm,
terms of, you know we guard against NAV erosion. We try to outperform what we're going to track, and then we want to be as steady in terms of distribution as possible, right? So
yeah,
people can predict what we're doing, even though the portfolio might shift around. The output will be pretty predictable. So it will be in the same style of curve funds. That's what curve funds are known for.
right. Do you still have the one page on your website where it was like a comparison of, I want to say it was
Yeah,
yeah.
if you go to strategies, I think, on top,
Okay.
and
Hmm.
then, actually, no, resources. Sorry, we're actually redoing a lot of our websites. You can take a look at KQQQ.
No.
There is, we do a comparison of that versus, actually we straddle two different categories, which is,
Oh.
technology and income
Mhm.
strategies. So here you can see, this is as of August. Well, the September one is going to come out, I think, shortly. But you
Yeah.
can see from a total return standpoint, the straw man for this fund is triple Q. So we've been able to, um, do better, than that particular fund. But also, actually, most of the funds that, in the universe. But what we really care about is actually, how much risk do we get to get that return. So if you look at the volatility, our volatility is actually right in line, and actually somewhat lower than a lot of the tech funds, pure tech funds. So if you divide like return over volatility, so it's like per unit risk that we took, how much return can we generate, right? We're actually doing pretty well. And then we have this is August distribution. Now it's up to 18% in September. So, we're actually pretty competitive on three of the metrics that we find most important for our strategies.
Hmm. Yeah, looks good. Um, let's see. What else was there in the resource? Oh yeah, you have for three funds, TSLP. It says
Yeah, this one I think we need to update, but I think that the result is still pretty much in line, which is, if you look at, and this is if you go down, and what I mean by total return is how most people measure it. It assumes that you reinvest all of the dividends that you have. But we know a lot of income investors don't reinvest. They use the income, right? So once you've done that, the returns look very, very different.
Yeah. Oh, absolutely. Yeah, with 100%, with 50%, and with no reinvestment. Wow, that's really impressive.
Yeah, that's if you just take, if you just took all of the income and used it, right? How much NAV do you have left, essentially? Yeah.
Mm-hmm. True. And then let's look at the Google one. Interesting. Wow, that's a big difference.
Yeah, and then we'll update this up to September. I think we try to do it quarterly or so. Yeah.
Mm-hmm. Oh, that's funny. Curvature perspective.
Yeah.
Play on words. Yeah. What's the 351 guide?
That's more for advisors, folks who have clients who have highly appreciated securities. It's like a tax solution for them. So yeah.
Okay. So that's another good question too. Are you seeing institutional money coming into these funds?
Yeah, a lot of advisors who are allocating on behalf of their clients' portfolios, they are seeing the same thing. The market is actually acting very strangely, right? You have the risk on people, right, who likes tech and Bitcoin, and that those assets are continue to go up because I think the explanation is that they see weakness in the economy, which is going to force the Fed to cut rates, which means a lot of these growth companies are priced on a discount rate. The lower the discount rate, the higher valuation, or at least price support for the name. So that sector is doing really well. And then there's the other ones who are like, oh, the economy is slowing. I don't trust dollar assets as much, so I'm going to diversify it out into something that can retain value. And the two choices are gold and Bitcoin. And you see those asset classes doing very well as well. So we kind of have barbell both sides, and a lot of advisors are actually, we don't know if it's a risk on or risk off, but at least we have both exposures that's in the portfolio. Yeah.
Interesting. Very interesting. Well, good to hear. So yeah, as soon as that new fund comes up, we'll definitely have you back on, hopefully sooner rather than later. And then yeah, passive earnings says we need the same quality and strategy as Kurv already provides. It's amazing, but a little more dividends from Bitcoin volatility.
Yeah, I will say that it will be something that we probably will. It's something that we've looked at, and we probably will incorporate in one of the strategies that we have. So, yeah.
Awesome. All right. Well, thank you so much for coming back on. That's about all we have today. But yeah, we'll, like I said, look forward to hopefully ending the year on a good note market-wise and some new funds.
Yeah, it looks like there's a lot of folks who really like Kurv funds. If you could do me a favor and let people know, because we've had a pretty good word of mouth, but always.
Yeah, no, it's getting out there. I think
the more would be great. And
yeah, the more that you guys continue to like outperform Teslas and other funds of the world, is definitely going to get out there. And there's a big demand. I'd say 80% of the audience wants the more stable dividend with lower NAV erosion. So yeah, I'll probably even cover it more. Yeah.
Okay, that's good to know, actually. And getting that feedback is actually really useful for us as well. So as we develop new strategies and things like that. Yeah.
Absolutely. All right. Well, thank you again. And to the audience, thank you all for tuning in today. Please remember to like, comment, and subscribe, and join Discord, and also check out Kurv Funds. Thanks, everyone. Bye.
Thank you.
In the live stream, and then let's see. Oh, yeah, he says Kurv's the way to go. All right, end stream.